Okay, time to answer some questions from Sunday's market outlook. Five quick ones here, six quick ones here. 435. Could the quotation be based on T+2 settlement, meaning instead of having 7 days of 383, it would be 5 days since it takes 2 days to settle? The yield listed is for what's called a constant maturity yield. So it's a 30-day constant maturity. It has no there's nothing in there about settlement whatsoever. It is the yield for that particular security. Settlement is when you buy it. It wouldn't be within the quote itself. On Monday, U.S. markets closed up 1%, but the VIX closed up at 25, nearly 10%. Why is that? Because you were sitting in front of a big event, CPI. That's why. Implied volatility always rises before big events, called event volatility. You see this quite often in company earnings. If a company is reporting earnings after the bell or the next morning, volatility increases significantly in the options into the close. And then once earnings are released in the next morning, you get something called the volatility crush, where volatility comes right out. So Monday, VIX closed at 25. Today dropped to 22.69. That is called the volatility crush because the event is gone, and as the market unfolds, that volatility comes right out. After the Fed tomorrow, depending on which way the market goes, you'll see this drop as well. Even if the market sells off into the day, I do expect that this will probably come out as well, because some of that is because you have event volatility in it. Why at the target Fed funds rate of 3.75 to 4 is it rational to see the effective federal funds rate at 3.83? Why not 3.875? Why is it always closer to the lower bound? It's not always closer to the lower bound. This is a market-determined rate. The effective federal funds rate is market-determined. It's not determined by the Federal Reserve. The Federal Reserve engages in open market activities to target the range between 3.75 and 4. So if this started going down to 3.75, the Fed would do nothing. As soon as it dropped below 3.75, the Fed would step in to drive that rate back up. But as long as the market keeps the rate between 7.5 and 4, the Fed does absolutely nothing. It just simply says, here is our target range for the overnight rate, and it does nothing. The market, because it believes the Fed will step in at 3.75 and 4, the market tends to keep the rate between that range. But there's nothing saying it has to be the middle of the range. It can be anywhere within that range, but it is all market determined. 109.40. Can we use contango backwardation of VIX futures as a predictor for equities? Somewhat. They tend to be in contango roughly about 80% of the time. Whenever you have a spike in volatility, for instance, the pandemic shut down, you had volatility spike really high. When that spikes really high, volatility ends up being above the front month. It drags these months upwards so that you get backwardation. Whenever you have a big spike, the more backwardated the futures curve is, the more likely there is to be a drop in volatility, which could be a good sign to be buying equities. But you see a volatility at 40 very quickly, you could get backwardation, but that 40 could go to 70. So you could get crushed playing that kind of volatility if you're on the wrong side of it. But the nice thing about volatility is if you have the capital and the patience to just to keep rolling over your futures, volatility is a mean reverting series. When it's too low, it will revert higher. When it's too high, it will revert lower. Yeah, you can use it as a predictor. The steeper the contango, I'd say the more I'd pay attention to it. But if it's just something like that, or even backwardation, which isn't very steep but kind of flat like that, I don't know that I'd pay too much attention to it. At 28.43, you mentioned that mortgage refi app is up 4.7%. Is that year over year, month over month, every Wednesday morning at 7 a.m. you get the mortgage applications report for the week ending the previous Friday. So it is week over week. So that refi app up 4.7% is up 4.7% from the week before. What is supporting your thesis that mining stocks and home builder stocks will be the winner in the next cycle? I think I've in previous videos I've repeated this many times. I did a long video called "The Ice Age is Not Over," so you can go look at that. ICE, internal combustion engine. The Ice Age is far from over, or the Ice Age is not over. In there, I lay out the case that there simply is not enough mines on the planet today to produce the amount of EV material, battery material required to meet all the plans of all the automakers by 2025, 2026. You're going to hit a wall. If you think that there is a shortage now of key materials for battery, you're gonna, if the car companies keep pushing and pushing the way they're doing, you're gonna hit a wall. Not only that, if you're electrifying everything, copper. Also, what did I hear today? Zinc supplies are in warehouses are low. Aluminum is going to be a huge thing because you got to move a car down a road. You get better range off a battery if you have a lighter vehicle. So you're not making steel panels anymore, and you're probably not moving the carbon fiber because it's too expensive. Aluminum is going to be a big thing. Lithium is, you need more lithium mines. These things take years to build out. So there's going to be a price squeeze, a significant price squeeze. That's why I'm bullish on the mining stocks. Home builders, well, there is a shortage of housing. There has been a shortage of housing since 2012, 2013. There was a little bit of overbuilding. Let's not just say a little. It was quite a bit of overbuilding 2007, 2008. But then the housing crash happened and the amount of new home construction fell. And you need a certain amount of homes. We'll just draw a straight line. This is for family formation or new household, not family, we'll call it household formation. New household formation used to be much higher, but being the population growth is so low now, it's about 1.2 million a year. New home construction is well below that, and it's been below that for a long period of time. So every year you need 1.2. Next year you need 1.2. Next year you need 1.2. Every year, well, it was 400,000, 450, 400, 500, 550, 400, and it was starting to come up, and then you had the pandemic, which created, a shortage of labor. And now we're, with high interest rates and high mortgage rates, home builders aren't building the spec, it's doing this again. So you still need 1.2. So even if you get to 1.2 million a year, which is, you'd have to double the amount of homes being built a year just to get to the run rate of 1.2, so the housing shortage doesn't get any worse. You have to overbuild for a period of time to fill this backlog. The higher mortgage rates stay and the higher home builders financing costs stay, they're not going to build homes to spec. They're only going to build homes to sale. So you need a significant amount of homes built in the US and in Canada, a significant amount of homes built. That's going to keep margins high for quite some time. So that's why I think mining and home builder stocks, simply because of the structural supply, and supply does not come to market very quick, especially with mining stocks. Okay, could you elaborate on what you said about not wanting to pay the SPY upcoming dividend? If you are short any stock that has a dividend coming up, if you hold it short through the ex-dividend date, you have to pay the other side the dividend, because you borrowed the shares from them and you sold them. That's how you end up being short. Well, if you sold them, somebody else is the beneficial owner of those shares. The person you borrowed them from doesn't know you borrowed them, still feels like they own them, but they're no longer the beneficial owner as far as the shareholder of record. They would not receive the dividend. Because you're short, you must then pay them the dividend, and I didn't want to pay the dividend. On the rate inefficiency, any end of year for taxes could be any reason. Trying to think of why I would want to buy a 30-year because of taxes. I can see selling securities that you have an unrealized loss on to offset any gains, but I don't know that anybody will be engaging in too much tax loss selling this year. I think during the natural course of the year, there was probably very few opportunities for significant capital gains. That most investors are probably going into the end of the year with some realized capital losses to begin with. Don't know why you'd be buying the 30-year for end-of-year tax reasons, but the inefficiency is starting to go away. We closed at 381 on Friday, closed at 386 on Monday, closed at 389 today, and you have the Fed meeting tomorrow, and it's got to somehow get above 425 to 450 will be the range. 389 just seems too low. It can sit below only because there is a demand for the 1 month, a natural demand for the 1 month from money market funds that need extremely low duration only because of volatility. They don't want to take on any interest rate volatility, so they need extremely low duration. And they do not qualify for the reverse repo window. So it can sit below the 425, but to sit this far below the 425 seems rather odd. We will see the closing tomorrow. If this finds its way up to, let's say, 410 plus, anything above 410, I think would seem to have to make sense, unless there's just a significant amount of money sitting in cash. But given today's CPI report, and given that the Fed is probably going to move 50 and signal that they're pretty much done with their rate hikes, but that they're vigilant, they're going to say that I think that volatility is going to drop even further, and there'd be less of a demand for cash. And if there's less of a demand for cash, it should come out of the 1 month and find its way further into duration with lower volatility. So I think it just could have been money moving to safety in front of the CPI, in front of the Fed. Do you think you can walk us through butterfly quote and how to interpret them? BF020510, that's the 2s, the 5s, and the 10. This is a Bloomberg quote for a butterfly spread. I want to be able to identify performance versus other points. So it's a curvature, not a curve trade, a curvature. So I'll put one dot on the 2. And let's find the 10-year, and let's draw a straight line. A straight line has no curvature. There's the 5-year. So we see that the 2, the 5, the 10 has some curvature. If we expect the 5-year to increase, that is these are the wings. The 2 and the 5 are called the wings, and the 2 and the 10s are called the wings. The 5 is called the body. So if we expect the curve to add curvature, which means the 5-year going up, we would want to be short the 5-year and long the 2 and the 10 because rates up, prices down, right? But if you think the curve is going to add even more curvature, this is adding curvature by moving up. This is decreasing curvature, even though it shows curvature. It's still decreasing curvature because it goes negative. Then you would want to be long the body and short the wings. So let's just take the 5-year basis point value, 42.57, and since you're only playing curvature, you want to be duration neutral. So you need to find your weights. You need a weighting on the 2-year, which is 34.71, plus 1 minus W on the 10-year, and the 10-year is 65.75. And you solve for W. Actually, it should be 2. Actually, no, not 2. 42.57, you find your weights. You'll find you're very close to a ratio of 2, 1, and 1. Very, very close to that ratio. And if you're using futures, which this trade is going to be using futures, it's going to use a ratio of 2, 1, 1. 2 on the body, 1 on each wing. If you solve for this, you add these two numbers together, you got 90, almost 100. Multiply these by 2, you're getting to about 85 to 100. The basis point value is kind of close. You do have a little bit of tail risk in there, but these positions are really, really small. But you would solve for your weights, depending on what your weights are. Institutions aren't just doing one. They would do, a significant amount. As far as earning a return in fixed income, you can earn a return from your bet on the level of rates, on slopes, and the third one is curvature, right? Levels are the biggest one. That's about 80% of all fixed income return comes from levels. About 16% comes from slope, and about 4% comes from curvature. Not that curvature can be ignored, but it's a small. They're small trades, and it's hard to predict. Much harder to predict curvature. It's easier to predict, levels. But if you have a Fed that says we're going to keep levels where they are for an extended period of time, other than on the long end of the curve, movements in levels on the long end of the curve, you probably will be looking at slope and curvature to beat a benchmark at that point. But curvature is, a small part of fixed income return. It's not a big deal on that one. Getting levels wrong, but getting slope right, I don't know that would help you very much, unless you really levered up your slope trade. At 37.29, how did you determine the price target for 50% retracement? Well, you have a peak price. There was a rally up to a certain point, and then it sold off, and then it re-rallied. So you take the high and the low of that last leg and divide, take the high point minus the low point, divided by 2, find the halfway point, and there you are, 50% retracement. I know you're bullish on mortgage REITs, but what are your thoughts on banks? Well, these are two different things, right? Mortgage REITs hold securities. They hold MBS. And they typically hedge out the interest rate risk component, and they use a lot of leverage, anywhere from 8 to 12 times leverage. And they are just leveraging the spread between MBS and the 10-year. So they don't do anything other than that. They just hold securities. Banks do a lot more. As rate hikes slow down and inflation decreases, the steepening of the yield curve could be pretty bullish. The current dividend yields are fairly high and pretty safe in most banks. Are there any reasons to stay away from banks at this point? It's very difficult to predict what is going to happen to a particular business, because businesses are full of strategic people that, given an environment, a good management team will adapt to that environment or may not adapt to that environment. So it really comes down to, when you have challenging environments, you really want a management team with a history of superior execution. So you really have to look at who's running the show. How have they, done in past difficult environments? Does their bank tend to outperform, not just in good times, but does it tend to outperform in bad times? Keep in mind, banks do a whole bunch of things. They don't just hold securities. They have a balance sheet where they make loans. So you have to think about demand for loans. It's not just the willingness to lend, but people got to show up with the right credit rating. So demand for loans is one thing. There's wealth management as well. There is issuance. They act as underwriters for IPOs and things like that. So there's issuance. There's M&A activity. So it's not just the interest rate and the shape of the and the curve. It's what's the level of wealth management, assets under management that they have, because when stock prices fall, well, asset portfolios decrease as well, right? So your assets under management naturally just shrink. Even if no one redeems their money, your assets under management naturally just shrink in a recession. Issuance slows down as well, because you're not going to issue IPOs would drop or slow down significantly in bear markets, because why do you want to issue stock in a bear market if you can wait 12 months or 18 months, get some kind of mezzanine loan from a VC and wait another 18 months. Same with M&A activity, that slows down as well. So you have to look at the environment under which banks would do well. Banks do well when cost of capital is low, demand for loans increases. When mortgage rates are low, mortgage activity increases. We've seen banks, almost every bank, lay off in their mortgage department quite significantly, lay off in their wealth management department. What is good for wealth management? Rising stock markets. Why? Because even if they attract no new money under management, assets under management just keep growing if they have positive returns, right? A rising market is great for issuance, also great for M&A. So we do not have that at this point in time. That doesn't mean that banks can't perform well given the price that they have right now. They could probably do well because the market has probably priced all that stuff out. But how long will this environment last? How long will rates be this high? We could be in for a long sideways market of 3,800 to 4,200 over the next 12 months. That's not an attractive market for rising assets under management. And if you have high rates over that period of time, you will have low demand for loans, low demand for mortgages. So there's a lot more than just the shape of the curve and what they can borrow money at and what they can lend money at. If you're looking at strictly lending, you're not looking at the large banks, you're looking more at the regional banks. They're more interested in just lending, so lower rates, the better it is. In your opinion, will QE return in the future? If so, what time frame are we looking at? Well, predicting is a tough thing to do. It's always better to predict or to describe the conditions under which something like this would happen. And then you think about how likely are those conditions as opposed to how likely is QE. And conditions under which QE would occur is stress in the treasury market, where you have extremely low liquidity, or stress in MBS, where you have extremely low liquidity and it's driving rates needlessly higher, not reflecting the time value of money and not reflecting any maturity premium, but simply reflecting a lack of liquidity. So they would probably step in times like that. The bigger one is if you are facing the specter of deflation. So that, CPI is coming down, and there's the zero mark, and it's threatening to go below the zero mark. Then you would have to do something to try to get inflation up, because the belief is deflation is deadly for an economy, but you can at least try to fight inflation. So those are the conditions under which you would need, with reshoring, with unions gaining more strength, with wage increases or wage inflation sitting where it is, with PPI still rather strong, with, I believe, a resource crisis in food and energy right now. It would be, I think, tough to get headline inflation down to the zero line on a year-over-year basis, so that you would be looking at deflation. I think that would be tough, probably over the next 5-6 years. So I don't know that QE is necessary, nor should it be. I mean, if your economy only works because the Fed is supporting the bond market to help support the equity market, well then, it's an engineered outcome. The government may as well just write us all checks every month if that's what we're going to do, because that's basically what they're doing, is they're just engineering the conditions under which people with experience will just get richer and richer and richer. It's not that the rich get richer, it's that people with experience get richer when the Fed does that. I think that returning to a zero line doesn't make a lot of sense for the overnight rate, that if they are going to cut rate, and Powell has mentioned this way back, that his belief was that you have to get off the zero line. You have to get off the zero line. So I think on the way down, I don't know that he would go much below 2.5. And if you have the overnight rate at 2.5, even if you have inflation running 2.5 to 3%, that's sufficient. I think in time there may be a conversation about why are we looking at a 2% target. Going higher can be dangerous as well, right? Let's say that you go to a 3% or a 4% target. and you keep the overnight rate equal to whatever the inflation rate is, yeah, it'll be much more difficult to get deflation at this point in time. And if you get deflation, you're starting from a 4% rate, you can drop rates down. But if you get any inflation, well, then you might get it up to 10 to 12%, right? Because you're already starting from 4. So I don't know, you know, if that conversation is worth having yet. But QE, unless you get massive deflation, like a faster decrease in inflation than what we think we're going to get, like it just melts away and starts threatening zero, I don't see it. In the near term, I don't see the conditions for it in the near term. Near term meaning the next 3-4 quarters. I was wondering if you've done any research on the BIS report regarding $80 trillion in currency swap debt that may have been overlooked by regulators due to its absence from balance sheets. These are quasi-collateralized loans in essence, right? Here's how it works. I have CAD, you have USD, because you're in the US, I'm in Canadian. I need some US dollars and you need some Canadian dollars. So we have a spot rate that we find today, and you give me your US dollars, I'll give you my Canadian dollars. You're not really out anything at this point in time. I don't owe you any money, really. The only money I owe you is the interest rate differential each month, because since I've given you Canadian, you have to give me Canadian SOFR. And since you've given me US each month, I have to pay you US in US dollars. I have to pay you whatever that rate happens to be. And then at the end of the term, we give our dollars back. Well, yeah, I owe you US dollars, but I've already given you I've already really technically bought those US dollars from you by giving you Canadian at whatever that spot rate happens to be. So if I default, well, you just don't give me the Canadian back. But I've in essence bought it from you. Think about it like a repo, right? I'm going to give you this treasury security and you're going to give me some money. And tomorrow I'm going to come back and buy this treasury security. Well, if I just don't come back, you got the treasury security. Go ahead and sell it. You've got it. You know, you don't have a 100% loss. So, you know, the idea that there's this hidden amount of debt. Technically, under the currency swap, I am on the hook for returning these US dollars to the other side. But in returning these US dollars, I'm getting Canadian dollars back. So you could say technically the other side is on the hook for the other side of the currency. So you can't just say, you know, oh, there's $80 trillion of US debt. That means there is 80 trillion multiplied by, call it the DXY, for example, and there is a debt on the other side. There's debt on both sides, so if you just don't pay, then, you know, I don't know what their point was here. Maybe to point out that, I think maybe they were trying to point out that, you know, with fewer and fewer US dollars, if you're shrinking M2, shrinking the money supply, this 80 trillion in US has to be returned in exchange for the other currencies. And maybe it might be difficult to get those dollars, but it's not as if $80 trillion is owed by someone and the other side is going, uh-oh, I have no collateral. They already got paid. When you say low volatility environment, does that translate to less day-to-day price movement in the equity markets? Yeah, that is what low vol means. As in, if we are seeing plus minus 1 to 2%, $2 to $7 fluctuation days in SPY now, we might instead see plus minus 0.25 change days. Yeah, exactly. What sort of macro environment would produce these results? And would it then be more difficult to profit from options given the lowered volatility? Yeah, well, it would be more difficult to profit from options on SPY. But you then move down to the level of the security, and securities have different volatilities. You can have low volatility securities like you would find in XLP, which is consumer staples. You might have low volatility in relation to the low volatility in SPY, or you can move to some other securities that have higher volatility. Home builders and mining stocks have very high volatility, so there's still a lot of good stuff that can be done with those particular options. So in a low volatility environment where the market appears to be going sideways, there's still some good money to be made in short straddles on long positions in those particular stocks. It just there's less return per dollar of margin required at the level of the index. Given the depth and duration of yield curve inversion, recession probability seems high. Can we look at it the other way around? Is there a bull market thesis that incorporate a yield curve inversion? Yeah, what we could say is, so we have something that looks like this. There's the 1 year, there's the 2 year. There is an inversion between the one money market and capital market. This will reflect Fed activity. This will reflect either inflation expectations or growth expectations. So when you have an inverted yield curve from a very high level of inflation, you could interpret it as capital market securities are pricing in a lower inflation expectation. Or you could interpret it as capital market securities are pricing in a lower growth environment. One is a soft landing scenario, the other is a recession scenario. Thing is, it's kind of hard to pull those two apart. Which one is it? So yeah, it could be seen from a bullish perspective if you're in the camp of a soft landing, saying you can't have a recession with the labor market this strong, which is probably true. So unless you start printing, jobs reports start printing negative jobs growth or less than 80,000 jobs per month, it's difficult to see that the inversion is reflecting, recession, but it is reflecting recession fears, or it's reflecting inflation expectations coming down. It's not quite clear yet, so only time will tell. And if we see leading indicators, the leading indicator index still turning down, if we see a PMI still turning down, and we see jobs reports starting to print negative numbers and initial jobless claims coming in at 275 to 300 or higher, all of this leads credence to the low growth expectations pushing down the long end of the curve. But if leading indicators start to turn up, if initial jobless claims hangs out around 200 to 225, if the PMIs stabilize and even start to turn up, you got to make the case for inflation expectations. But if this starts to happen, then would inflation then show up again because we haven't gotten it out of the system? And if it showed up again, would you then start to get a bear steepener of the curve on the long end if the Fed had stopped? It's hard to make a prediction about anything. All you have to do is be aware of the environment under which a soft landing would occur, and you watch those variables. And those variables are the leading economic indicator, the PMIs, the initial jobless claims. Well, actually, all of these would be wrapped up in the LEI, but it's still worth watching the week-to-week indicators that would find its way into LEI. And you got to keep watching inflation. We have inflation that did this. It rose and then it kind of went sideways for a bit and then it rose again and now it's doing this. Well, that doesn't mean it can't do this, right? It is turning over. So far, so good. But if financial conditions loosen, if mortgage rates continue to drop, if the Fed signals that they're near an end and you get a treasury curve that starts doing this more and more, that starts doing that kind of thing, and financial conditions start loosening, you could drive inflation back into the system. If a recession is coming, does it always involve a massive drawdown? Not really. It doesn't always involve a massive drawdown. It depends on what's going on with earnings, right? And is a massive drawdown always caused by a liquidity issue? No, not really. Is it possible to spot where the next crisis would originate from? Not really. No, not really. Or these things largely done in hindsight? Usually, well, everything in hindsight is perfect vision, right? There's a reason Kramer has a show on at 6 p.m. He can tell you exactly what happened that day. And you think, wow, that is what happened that day. But, you know, give me a show at 6, give me a show at 5 p.m. and I'll tell you an hour before him what happened that day. Typically how it works is we have an EPS of 224. And we're expecting a low growth environment, which if you take out the energy sector and you take out probably the top 3 or 4 stocks that make up the majority of, like a good significant, not the majority, but still sitting at 10 to 15% of the index, is sitting around 17 times, maybe a little under 17 times earnings. In a low growth environment, you might get down to 16 times earnings. So, we're at 4,000. That might get you to 37.75. But how it works is when you have earnings that are dropping, you'll also have a multiple that is dropping. But the multiple will drop like this and start to rise as earnings are still dropping before they bottom out. So the multiple will start rising before earnings start dropping. So, when we say that earnings could get down to 200, the multiple could get down to 14. 14 times 200 is 2,800. Typically, you'll get to 14 down here and you'll get to 200 down here, so that, once you bottom out on the multiple, it'll start increasing even before earnings bottom out. That this might be a multiple of 16 by the time earnings, by the time earnings bottom out, you might be at around a 16. So that would put it more at 3,200. So taking the low on the multiple and the low on the EPS to get to 28 is an extreme point. Usually you would extrapolate that, the multiple will drop before it increases, and then earnings will drop, so that by the time earnings hit a bottom, the multiple has already expanded. Okay, somebody wanted me to interpret the implied volatility, the screens for the implied volatility viewer. So let's look at the top screen here, and we have this is the screenshot they sent me. There's January, February, and March that are selected, and we have you can see where the current price is in here when this screenshot was taken. And let's look at the February one. There's February in the middle in terms of implied volatility. So you can draw this out to here, and that is what that is telling us. That is an at the money volatility on this side. So the red line is February expiration. It is one expiration at multiple strikes. And there's the 400, the 410, the 420, 430, 440, 370, 360, 350. So each line is a particular month at different strikes. This down here is different months at one single strike at the money. So this is the implied volatility at the money for, there's December, there's January, there's March, April, June, September, there's December, January 94, June 21, for as many option months that they have listed. And you're basically seeing that we have basically a flat term structure of implied volatility. Once you get past every current month, we'll have this kind of thing going on. Because I shouldn't say current month. In the last week before options expiration, the at the money will show huge implied volatility, only because there's huge gamma risk. And if dealers are going to take on that kind of gamma risk 2-3 days before expiration, they're going to want to get paid for it. So you can't really read too much into that. But if you go out, 45 days or something, that gets you to January, 30, 45 days. We see we have a flat term structure. It's not suggesting, that we have excessively high or excessively low volatility. It's suggesting that, we're going to probably, at least the options are pricing in this level of volatility for a period of time, because we're at no particular extreme. at this level. And VIX has been dropping over time. When we look at a 3-year chart, we have this kind of thing going on. So even when it does spike, it's spiking lower and lower. And we did have a little breakout. It's back in here, but it is coming back down. Where it's going to go, who knows? We got the Fed tomorrow, and it's all about that press conference. But that's how we interpret this. This up here is 1 month at multiple strike prices. This down here is multiple months at one strike price. Okay, next one here. I have seen that the federal government current interest expense is the highest it has ever been by a long shot on the Fed site. Do you think there's a chance that this could cause the Fed to need to cut rates separately to anything having to do with the recession? No. You're looking at let me put a period there so it looks like an exclamation mark. You're looking at the wrong thing. You are looking at interest payments. Yes, highest it's ever been. But you also have to keep in mind that debt has done this as well, while GDP has done this as well. So you have to look at interest payments as a proportion of GDP. Now, if interest payments as a proportion of GDP keep increasing and increasing, that becomes unsustainable. Well, here we are over here. So if we draw this line straight back, this was a far more dangerous period. The 80s, the 90s, got through that without much of a problem. But as a proportion of GDP, it was really high. As a proportion of GDP, it is quite low right now. So even though the debt is high, a lot of that debt has been issued when interest rates were, on the 10-year, 1.2, 1.3, 1.4. So it's only new debt being issued now that has the higher cost associated with it. So no, it's not that big a deal. And this is the one you want to watch: is interest expense as a proportion of GDP, not just interest expense on its own. Your question continues, so let me just read it off the screen here instead of putting it on this screen. I'll just read it. Let's see. If this happened, my understanding, if this happened, saying that it could cause the Fed to cut rates. And if that happened, it would be very bearish for the TLT trade, as higher long-term inflation expectations would be priced in the long end of the curve. Yes, that is the one risk to a long-duration trade right now, is that the Fed stops raising rates too soon or cuts too soon, and the market reprices inflation expectations back into the curve. Right now, the curve is being held down nicely by lowered inflation expectations by about half the market and low growth expectations by the other half of the market. And neither one, and the only way that you're going to get that curve shooting up is if you get both higher inflation expectations and higher growth, then it'll really go up. But you can get higher inflation expectations along with the expectation the Fed's going to raise rates, but lowered growth expectations, and more people are in the recession camp all of a sudden, which keeps the curve inverted. So it's hard to tear these things apart because everything feeds back onto everything else. What do you think the chances are that the Fed decides to live with higher inflation rather than crash the economy? If it looks as though crashing the economy is what it would take to bring inflation back down to 2%. Well, they seem committed to the 2%. Until they say otherwise, I don't think that it's wise for us to make bets otherwise. We pretty much have to live with that as well. So I think it's too early for them to start talking about raising their inflation target, because the market would perceive that as the Fed giving up. But I think that once we start to see, over the course of a year, inflation headline coming down to 4, 3.8, 3.6, that they might start thinking about, the environment that they're in, and they could make a good case that it might be worth raising the inflation target to 3%, maybe, and hold there depending on where rates are. But I think it's too early for them to engage in that conversation. Okay, on the curve, steepener trades are these NOBTUT ETF tickers. Not quite. I've been following this notion that eventually the curve will steepen, as I believe recession is more or less inevitable. I've been looking for a way to take advantage of this forecast. When I search these tickers into any platform, I don't know how many platforms you have, I was unable to find anything. They all said ticker unavailable. Thank you for any clarification I may have missed. I will show you an IBKR. After I answer this and this, the very next screen, I will show you in IBKR how to get it, and it is as easy as typing in TUT. Then I will show you how you can do it yourself if you don't have TUT, but you have access to futures using ZT and ZN and just setting up the trade on your own. Over here, for selling naked calls and puts, would you ever set a stop loss at a break-even price as a form of upfront risk management? No, I don't use stop losses. I manage my positions myself. I have a very good feel for where I am at any given time. If I'm going to go away for a long period of time, I'll use a limit order that if I want to get out of something. But I rarely use stop losses. I know when something hasn't worked, and stop losses, you get stopped out more often than not, depending on where you're putting your stops. And I found that if I just have patience, most of the time things work out for me. Most of the time, because I think things through very clearly, which means I'm taking positions from what I believe is a well-informed perspective. That if the market doesn't agree with me right away, oh well, you know, I'm okay giving it time to work, so no, I don't really use those. What do you think about the idea of base effects for annual CPI are leading us to much lower CPI within the next 2 quarters? Purely from a mathematical standpoint, there's a compelling case that it will. Yeah, well, if you had inflation going up like this, and let's say this is a 2-year period, and you're looking at something like this, you can move this over here and it would look something like this. So yeah, the base effects would be decreasing. As long as the month over month is decreasing, the base effects would cause CPI year over year to decrease. But, you know, let's draw a timeline. If we're right here and we're looking at year over year, that is over the past year. I prefer to take the month or the last 3 months and annualize that to get a forward-looking measure. We have a large concentration of historically extremely high monthly CPIs coming up from January to June. Yep. As these move off the back of the annual curves and are replaced with likely much smaller values. Well, there's the assumption, right? Replaced with likely much smaller values. It's okay to write a sentence like that, but make sure you understand that there is your assumption. That's not a statement of fact. That is an assumption that you're making. Be aware that that's the weakness in your statement. Being replaced with likely much smaller values. The likely is your assumption. Obviously, this is the great unknown. Inflation would drop rapidly. Inflation would appear to drop rapidly year over year, but it's the month over month. So the inflation read we had today, if you take the 1 month and you annualize it, it is quite low. It is lower than the year over year, which is what we should be doing. If you split the previous year's month-over-month inflation figures into 3 time periods and annualize it, you get November 21 to February 22 is 8.4, March 12, October 2.7, evidence of decline taking place, yeah. Based on continued lower path of average 0.2.4 month-over-month, the Fed funds rate of 5% by January. Well, you won't have 5% by January because we're 3.75 to 4 now. We have a December meeting. We're expecting 4.25 to 4.5, and you don't have another meeting till February 1st. So you won't have 5% by January. You'll have middle of the range 4.375. That's our best estimate of what the effective federal funds rate will be, but the market will determine what it is between those 2 points. Is it possible to see Fed's funds greater than CPI as early as February, March of 2023? Well, if we take the 0.3 that we had today, 1.003, and you compound that for 12 months, you get to 3.65, 3.66%. With the 1 month annualized, 3.66, we're already there. The Fed funds rate is over. The effective federal funds rate right now is sitting at 3.83. if we just add 50 basis points on, we would expect 4.33, and the 1 month annualized is 3.66. So we're on track. We're already over. The reason I'm doing that is the interest rates that we look at are forward looking. You don't want to have a backwards looking measure here and compare it with a forward looking measure there, right? Okay, what we'll do on this screen is we'll type in TUT, we'll hit enter, and there's the whoops, just disappeared. TUT, enter, move the mouse over here, enter commodity spreads. You see the 2-year note, click on that, and we're looking at 2023-03. There it is right there. We can add that and click OK, and NOB, if we click that, hit enter, there's what we're looking for here, the intercommodity spread. Again, 2023. There's the March. You add and click OK. You'll only get them for the next quarter. They roll over. So there you are. You would have to be on a platform that supports the combination of these. And if you don't have it, it's rather easy. If I hover my mouse over it, you could see buy 2 ZT for March and sell 1 ZN for March. So here's ZT for March. I can just click here and I can say I'll take 2 of these. I can find ZN for March. Here is ZN. Off I go. If I want to set them up myself, I can go all the way out to June. TUT will only use the March contracts, not the June. I can use June, but I'm facing a whole bunch of leg risk legging in because they have much wider spreads. When you have to get them independently, there's a bid and the ask spread, right? So you may not get, like when you buy TUT directly, it exercises both legs for you at the same time. So you don't have any leg risk, but you might exercise one and then suddenly, for no reason, the market moves on you and you got to chase the other leg to get the other leg. That's where you have the risk. But if you don't have TUT, but you can get ZT and you can get ZN, you can do it yourself. Just buy 2 ZT, sell 1 ZN, because for the TUT, that's all that's doing. You can go out to June on ZT. Notice the spread here. You have 103.007, 103.008. That's tight. You can even just hit it at the 08. Here you have 2.6 to 2.65. You can hit it at the 2.6. So you can take the offer and hit the ask here, and you're fine. But look at the spread between when you go to June. Sorry, here we are, June, right here. 102.243 to 104.043. That's a huge spread. So that's why, you're going to face a lot of legging in risk if you're using June. But you could just do it on your own, or you could just type in TUT or NOB. You got to be on a system that supports this transaction. Okay, first one. I'm not sure I follow it entirely. Rates increase is bearish and opposite for being bullish. If long-term rates are more bearish or less bullish than short-term, it's steepening and opposite for flattening. That's where I lose it, as I'm trying to picture in my head what you're picturing in your head and I don't see it. Logically, in case of disinversion, it's actually flattening, at least graphically. Yeah, that is true. That does bring confusion on that one. So if you have an inverted yield curve and it does this, it appears that it's flattening, but that's actually steepening. So steepening, basically, think about it this way. Where this is 0, this is negative, this is positive. Anything moving up is steepening. Anything moving down is flattening. That's the best way to think about it. So if you take the 10-year minus the 2-year and you get a negative number, you're down here. If you think that it's going to get more negative, that's flattening. If you think it's going to get less negative and move towards 0, that is steepening. So if the curve started doing this, the market would call that a bear steepener. Bearish because rates are going up, steepener because the distance between the 2 and 10 is getting less negative. In my opinion, it should be named differently. Yeah, well, yeah. Yeah, it can be confusing until you start seeing it this way. Then it's just more negative is flat and more positive is steepening. How about long-term rates increase in addition to short-term rates fall? That's steepening. Yep. But bullish or bearish, it doesn't matter. It doesn't matter. If you're playing a curve steepener, you've set it up to be duration neutral, so you just don't care about the bull and the bear anymore. The bull and the bear refer to levels. That's all, just to levels. So if you are playing a curve steepener, it is set up such that you are duration neutral, so you don't care about the bull or bear anymore. You only care about steepening and flattening, and you don't care how it comes about. It does not matter to you how it comes about, as long as the 2 to the 10 becomes less negative and moves towards 0 and even becomes positive. Rates could be dropping dramatically or rising dramatically. You don't care. When you are assessing the macro outlook or potential trade investment, do you put together a report on your bull, base, and bear case scenarios? Not really. I don't write a report because it's just for me. I do make notes. I don't just read and try to remember what I've read. I make notes and I review my notes and I look for connections. I look for things that tie things together. As you review your notes, it starts to tie things together for you, but I don't write up a full report, no. Also wanted to ask if CME Group has any tools for looking at implied volatility and level of skew on VIX and SPY as well. Well, I'll show you how you can find the ES Mini, which is, it's the same thing as SPX, and look at the volatility viewer on that, or the volatility term structure. There's not a lot of information there. It's not very useful. Typically, you would use your broker for that kind of information. Have you used the IBK app? Yes, I have. If so, how do you find Delta Beta on the app? You don't. Not everything is available on the app. Similar question, would you know how to find the Sharpe ratio in IC for a retail investor account on IBK? Yeah, it's in reports. When you go on, you have to go onto the site and generate a report. You can find that. I think you can also find it in one of the, I don't know where it is really. I looked at it once. I had a Sharpe ratio of 8.6, which is ridiculous. It's only because I use so many options. And when you use options, Sharpe ratio is meaningless because the denominator of a Sharpe ratio is sigma, which assumes a normal distribution of returns. Well, when you use options, you have significant skew. So the Sharpe ratio becomes absolutely meaningless at that point. You can always get your Sharpe ratio up by using options, always. But you're not going to have a normal distribution in your return series, which means you're looking at garbage. As far as an information coefficient, no system would know your information coefficient. I mean, you can't calculate your information coefficient because it is a correlation between your estimate of active return and actual active return, which means that you would have to have some documentation somewhere of what your expectation for active return was, and then what was your realized active return per security, and then you calculate your information coefficient. Or you could get to an information coefficient by decomposing the active return, the fundamental law of active return, the formula for that. But then again, you're going to need some information that you track yourself. But this is the IC is based on relative performance, and that's if you're holding true to a benchmark. And as a retail investor, I'd say, what's the bloody point of doing that? Who cares about this? And as far as your Sharpe ratio, as soon as you throw options in there, if you're using a significant amount, that's useless information as well. The only thing that I think really matters is what was your return for the year. That's the only thing that matters, is your return for the year. I am wondering, what is your thoughts on AI and labor participation? Would you think that AI would improve company productivity and also solve the labor shortage issue? Or is it more of services jobs, which is kind of hard to replace by AI? Well, I think in time, AI will make inroads, but there's a lot of things that AI, the limitations that they cannot do. So, routine physical, routine cognitive, that has been being automated and has been automated for quite some time. AI is meant to take non-routine tasks and automate them, which is, why you need artificial intelligence, because if something is non-routine, it's very difficult to program that. The robot or the system has to identify the context and then make the decision from the identification of the context. We as humans can see nuances in context immediately. That I don't know that that AI can do it as effectively, even though they could do it faster, which means that once they decide on a context, they can execute much faster than a human, but they have a probabilistic context in mind. In time, I think that AI can replace some humans, but the field of AI may create as many jobs for those that are creating the AI and deploying the applications and servicing the applications than the people they get rid of. So the answer to that is, well, you don't really know. A lot of automation has replaced jobs, but if you look at the amount of jobs in the US over time, it's done this. Even as automation has replaced jobs, is because every field that starts up creates its own jobs. So these jobs are all created over here, which eliminated these jobs over here, and then new industries start up here, which eliminates these jobs over here. So it's sort of an evolutionary growth. Yes, there'll be some creative destruction because of AI, but there'll be some new industries that would not have been possible without it, that suddenly create a whole new industry and ecosystem on its own. Okay, so under quick strike tools, find volatility term structure. You'll get this. I don't know why it defaults to natural gas, but it'll have natural gas up. Just top corner here, select a product, go to equity indices. There you are, and here's the E-mini S&P 500. Click on that, and there you go. That settlement means it's closed, and the futures are right here. And then I don't know if it has any other options here. View and full screen print chart, that's about it. Not very useful overall, and I don't know if there's anything more for it. It's a matter of just playing around on the site and seeing what you find. I use Interactive Brokers for more information, a lot better, well, a lot more granular information than this. I don't find this very useful, but that's about the most they have, I think, at least that I know of. Okay, I asked you a question a couple weeks back about the central banks losing money. You countered with an explanation that was the Treasury that lost, not the actual central bank. BNN Bloomberg published an article entitled Bank of Canada lost $522 million in the third quarter, marking first loss in its history. Well, that is true. It goes that the central bank paid out more in interest to the big bank settlement accounts than it received on its government bond assets. That is true as well. Would appreciate it greatly. Provide your 2 cents worth here. Nothing has changed. You have a treasury and you have a central bank. Central bank makes money, gives it to the treasury. So there is no concept of retained earnings. Central bank loses money, doesn't give anything to the treasury. Central bank makes money, it covers off its losses. It makes money, covers off its losses. It now has a surplus, gives it to the treasury. That's all it is. So it's the treasury that's losing, not the central bank. The central bank is just, kind of like the middleman in this respect. All the money gets returned to the treasury. So if anything, the treasury would just have to issue more bonds to make up for the money that it normally would get that it's not getting. Could you show us a real example in IBKR of how to hedge currency exposure using futures? Yeah, if you have US dollar exposure, let's say that you own some stocks in the US and you have US dollar exposure, I would buy CAD futures. CAD futures are for 100K CAD, which, depending on the exchange rate right now, I think is sitting at 73,400 USD. So for every 73.4 in USD exposure I have, that is one CAD future. If the USD drops, my CAD futures will increase. It will offset. And this is paid in USD. My gains or losses are in USD on this one, because my losses here would be in USD. You just buy your currency. You just buy a futures denoted by your currency, because futures have as their underlying the US dollar. If you're looking for a different underlying on the futures, you're going to have to go to the exchanges in your particular country and see if any exchange in your country has that particular contract for you. I can make a quick answer here. This is not for me to answer. You have to answer it yourself. You got to back test that. I don't know the answer to this question. I have a question regarding buying layered puts at different maturities to protect long-term positions. That's going to cost money. Always costs money, right? When IV is low and puts are cheap, one could buy a set of layered puts, 10% out of the money, expiring 3, 6, and 12 months out. Well, 10%, 12 months out, still going to cost you money. As time goes on, whenever IB becomes cheap again over the following months, when we roll those puts yet another 3, 6, 12 months out. Backtest. I don't know the answer to that. I really don't know. It depends on how the market moves. Those puts may never, ever, ever pay off, and you always have them there as insurance, and because you're paying out insurance, it is a drag on performance. If it makes you sleep well, then that's fine, but they may never, ever, ever pay off. If you have a market that's doing this, over time, you're just dragging your performance down. So unless you back test it, you'll never know. But if there is easy money out there, it's already been taken advantage of. Like, if this is something that just worked, that really worked, it would already be taking advantage of, such that it wouldn't work. There's nothing really free hanging out there, not on a scale like this. And you got to back test it across different years, right? Some years you might find that this strategy really worked. In other years you might find, this didn't work at all. So if you did 2021, something like this would have just been a waste of money. Okay, question about small caps. Any idea why these continue to trade at such a discount versus large cap stocks? I'm not sure about what you mean by discount. Historically, the S&P 600 has traded a much higher PE versus the S&P 500. But that has disappeared since about March of last year, and the divergence between those continued to widen over the past 18 months. I understand there's some differences with respect to sector weightings, but it seems like a historical anomaly. Well, we're not in an environment that favors small cap stocks. I think about a year ago for 2022, when I did it was late 2021, I did a year ahead look, and I said that 2022, or maybe it was the year before, I said that we are entering the era of large cap value is going to dominate for quite some time, and it has. We're just not in an environment that small cap does well. You need strong growth for small caps to do well, and you need money flowing into small caps to get that done, and we just don't have that environment. But quarter to date, the S&P 600 is up 12.74%, SPY is up 12.54%, so they're tracking each other. IWM as the Russell 2000 is up 9.98, but IJR has a profit requirement to be within the S&P 600. IWM does not. So you can call this has a high representation of unprofitable small cap, and this is profitable small cap. Is slightly outperforming SPY. For number one, I see today the 1 month moved even lower to 3.7. Okay, well, I think I've already answered that somewhere. I like the curve steepener trade. Too bad it's a big position for me with futures. But I'm a bit more skeptical on the TLT long trade. Haven't the markets already diverted a lot of where the Fed projects will be? what the Fed projects it will be. Many people talking about sticky inflation in the 3 to 4 range. I can't see much upside here unless the recession comes in fast in Q1 2023. Well, what's predicating the trade on TLT is one of two things: is inflation expectations continually coming out of the curve. And if that's the case, TLT will continue to perform for a while. I don't see a lot of downside if that continues to happen. If it doesn't, and the Fed has to keep raising rates, then it's a recession scenario. And if you hit a recession by the second quarter, first quarter, second quarter, you're going to have to stop raising rates or even lower rates, depending on how bad the recession gets. And TLT gives you the opportunity to hold, over time. You can continue to hold TLT. So if you hit a recession, TLT will pay off fantastically because rates will drop on the short end, and you'll get a bull movement of the curve downwards. And if you do it right, I'm not buying TLT, I'm buying calls for January 2024 at 115. You buy the calls. And if TLT moves up, great. If TLT moves down, well, then you get to go deeper or further down and sell puts. At some point, TLT is good to own. You'll sell puts to pay for your calls to get cash neutral. So, either I'll make money because the calls will go up, or I'll make nothing because I'll finish somewhere between the put and the call strike, or TLT will be put to me at a price that's very desirable because I've waited for TLT to drop back before I sell the puts. Once I sell the puts, I have what's called a risk reversal. I've stepped into a risk reversal trade. So I'm not natively owning TLT. I'm stepping into what, on a worst case scenario, will be a decent risk reversal. On a good case scenario, it keeps going up. Okay, last two questions here. You talked a few times about a synthetic instead of buying a stock in order to avoid taxes. The same trick can be done for ETFs with synthetic replication. Yeah, that's true. These ETFs with synthetic replication are using swaps and usually have lower costs than physical ones and can even beat the index they track. My concern is no real collateral. Are they safe to buy and hold as a passive investment? Yeah, just you figure out who the sponsor is, and if it's a significant name behind it, I don't really see a problem there. Hi, Mark. At what point would you start feeling comfortable leaving defensive ETFs like XLP and leaning into high beta ETFs like XLY? What indicators with the market would you be looking at? I think, with the lowered inflation, 2 months running now that we've seen, and if the Fed signals they're near the end of their rate hike, I'd be more comfortable taking on beta exposure. I don't know that I would be, getting right into consumer discretionary and small cap stocks, but I'd be more likely to take on more beta exposure going forward. I'd be less likely to sell calls on the index, but that doesn't mean I won't sell calls. I would just move it down to the individual stocks that I think don't have a lot of upside in a low growth environment, because even if we have a soft landing means a low growth environment. There are some types of companies that will not do well in a low growth environment. Consumer discretionary being one sector that would not do well in a low growth environment. It needs high growth. Also, inflation is slowing down, but let's just draw a timeline here and break it up into a couple of years. Over the last year, inflation has been significant, right? Well, inflation is coming down, but it is still inflation. It's not disappearing, so we still have increases over time. So prices are still going up. They're just not going up at the same rate. That is still going to eat away at people's finances, and consumer discretionary tends to be the one that gets hit first. So I don't know that I'd be jumping back into consumer discretionary yet, but I would be willing to take on more beta risk, depending on what the Fed says today. And that'll wrap it up.